Before we get started, I want to give a chance to everyone introduce themselves. So obviously, ladies first. Let's start with Rebecca. Rebecca?
Good morning, everyone. My name is Rebecca Prieto, and I'm with Popular Association Banking. I am a team leader, and I've been with the bank for 23 years, and I have plenty of cash to give out.
Well, that's great. Marnie?
Good morning. My name is Marnie Reagan. I'm a senior partner over at Haber Law. I do not have plenty of cash to give out, but I am one of the chairs of our condo department, and happy to assist and provide any insight that we have. Obviously, it is early in the session, but there's a lot going on and a lot to try to unpack.
All right, gentlemen. Gary?
Good morning, everybody. Gary Pyatt from Campbell Property Management. Been in the industry for 30 years, and I'm glad to hear that Rebecca has a lot of money to give out, because that's a big part of what we're talking about today. So thank you, everybody, for joining.
And now our insurance expert, Derrick Karadi.
Good morning, everyone. Derrick Karadi, Senior Vice President at Brown & Brown Insurance. 15 years in the industry. Here to help with any of your insurance needs or questions, and hopefully show some light at the end of the tunnel, despite what a lot of people have been going through, because I know too many associations have been handing out too much cash. And so we're looking to help them save it or work with Rebecca more.
And my name's Tara Stone. I'm your moderator today. I'm with Stone Building Solutions. We're the one-stop shop for all your reporting and engineering needs. I've been working with community associations for the last 15 years specifically, background in insurance, and now full service engineering, reserves, appraisals, and property damage claims. So before we get started, I got a little slideshow to share. When a bill is passed, the first thing is either the House or the Senate needs to introduce a bill. And you might have multiple competing bills in the House and in the Senate. We're going to talk a little bit about that today. It goes to committee review. It's debated in the committee. And at Stone Building Solutions, we had the opportunity to present about 3 weeks ago to one of the committees where they actually bring in experts and ask opinion, and they go back and forth. Then it goes to the floor of the House and the Senate, and it's debated within the actual full quorum of everyone. And then we're going cross chambers. If it's passed, the bill moves to the other side, and then it has to be passed by the House and the Senate. The bottom line is no bill can go to the governor if not first the House and the Senate agree. So what does that mean? It means that if the Senate is debating back and forth and they come up with the most perfect bill that they love and it's going to be great, and they know the House won't pass it, it's going to be dead in the water. So there's a whole bunch of communication back and forth to see what both houses have an appetite for, and ultimately what the governor has an appetite for, because it could go to him and he could veto it. So all three branches must agree on the bill when it's all said and done. So we're going to start with the House and break down the House bills and then move to the Senate. Let's talk about something great first, the My Florida Home Condo Pilot Program. And we talked about this last year, and then the money, $30 million, was gone in under 6 hours. They had to shut it down. So that was only the pilot program, and now the pilot program has been expanded. There was some challenges last year in the fact that it required 100% membership vote. Now it's only down to 75%. So that's really an obtainable number. It's 175 per association without limits. And the past bill, you could only do so much per unit, so much per window, so much per the roof. So this just allows the association to spend the money as they need. The big kicker is they've taken away, it's the whole state. We had talked about just being on the coastline prior. Now it's the entire state, but it's only for associations 3 stories or more, and it has to be at least 1 residential unit. And it also includes roof windows, but they've added, and it's actually coming out in the bill, I believe today, we have some insider information, wind mitigation for tracks of sliders. There's these really cool new technology out, like one of the companies I believe is called Storm Armor, and it's actually foam that you can put in the tracks when a storm comes, and it stops that wind-driven rain. So there's alternatives if you can't necessarily rip out the windows or it's cost preventative, you might be able to use the Safe Florida Home to save on wind-driven rain damages. Derrick, can you comment on how you've seen hurricane hardening affect premiums?
Hardening and being in compliance with all the milestone structural repairs and improvements, including that of the replacement of roofs and windows, make a significant impact on your insurance bottom line premiums. I would translate that to the equivalent of anywhere in the approximation of about 10 to 20% on each improvement. So to elaborate, if you did the windows, that would translate to a 20% overall reduction on your property premium only. And then in combination of maybe doing a full roof replacement on your property, that would translate to an additional potential 20% or so in a property modeling discount overall, depending on your other specifications as well. It is overall modeled, and so age and other considerations are also a factor. There's many different variables, but those two key things play a critical role into your bottom line of insurance when going through your renewals and getting those most competitive pricing.
So when we're talking about windows, let's really quantify that. If you have a $200,000 premium on a large high-rise building or a mid-rise building, you're looking at that, you're saying you're potentially saving up to $60,000 a year, maybe. So $60,000 over a 10-year period, that's $600,000 and money that you can also use on concrete restoration or other projects to harden the building. So
Yep.
when you're actually looking at a project, I think it's really underestimated. Associations just look and say, oh, what does this cost? What does the roof cost? What does the windows cost? And that hurricane hardening really can save. Gary, how do you have your associations? You talk about this in your meetings and have this in consideration?
Yeah, we talk about this in our meetings, especially the older buildings that are going through their recertification, SEER structural work, because most of the older buildings, the greater percentage of those units in those have either the roofing issues, windows, and especially the windows. I want to just highlight that because most of the older associations, those 40, 50-year-old associations, have the window issues and the leaking of the windows. So this is a topic, Tara, that we speak to all of the time. And it's a door opening for them. The only thing is
Open
that
the door. I got the joke. I love it.
what holds there you go. What holds it up a little is the 75% membership vote. I know we're going to talk about that later with some other things, but a lot of the associations can't get the numbers of unit owners to come out and vote for crucial items. So with the now require the 70, it went from 100 to 75. Fantastic. We're moving in the right direction. But with a lot of associations getting that, even that 75% membership vote is hard.
From an insurance standpoint, there's probably no time better than ever than what we've been seeing over the last 3 years, where prices for insurance premiums have been on a rise. We're actually beginning to see, for those of you who have not seen it yet, it's soon to come, a lot more stability in the insurance marketplace. We're starting to see the market soften just by the natural state of the marketplace and insurance companies, new and existing, coming back into the state of Florida. And with all the price hikes over the past few years, we're starting to see that the prices are really starting to come down a bit. So when compounding already an anticipated 10 to 15% reduction based on just market itself, and then hardening your buildings, you may be looking in excess of what it is we're estimating overall, which just further kind of warrants maybe making the informed decision to make those improvements to the building. I just wanted to state that. Ever since Surfside, underwriters have been scrutinizing more in the industry than we've seen in the last decade or more, right? But the fact of the matter is, once you make these improvements, once you're in compliance, once you're following through with these milestones, you open the golden gates to carriers of which would have otherwise declined you and open up their appetite then to deliver to you something more competitive and deliver you better premiums. And of course, the more competition there is, the lower you can improve your bottom line and other things as well. So absolutely, I strongly recommend it and encourage it.
So at Stone Building Solutions, we do a lot of projects, balcony restorations, and the associations say, well, we can't, as the association, do the doors and windows because that's the unit owner's responsibility. What we're saying here and what Gary is saying is like, we really need to look at the full pictures about forcing that, because if you're already having the contractors out there and doing the work, there can be such a savings to the association to kind of force some of these changes to happen. But nothing can happen without money. So Rebecca, can you please tell us a little bit about how a loan comes into play for hurricane hardening items?
Sure. So we provide financing not only for capital improvements such as the SERS, we also have financing for the insurance to help purchase insurances through Derrick, Brown & Brown. We can help with financing. We provide a line of credit over 36 months where the association will pay the dock stamps only on year one. And then they would pay on an annual basis. We will renew their policy. We have very competitive rates for that. In addition to that, we have loans for contingency, emergency purposes, such as to pay the deductible on a hurricane or for any sort of emergency, such as the cooling tower. Or we have the projects, the lots of monies for the projects, for the SERS and any capital improvement. We are typically, our terms are 10 and 15 years due to the size of the loans, but we have in occasions provided financings over 20, 25, and 30.
Here is the crux of the matter. We have two bills that relates to condominiums, specifically SERS and Milestones and some of these CAM and condo laws, and they're very, very different. So Vicki Lopez, representative in the House, has introduced this bill. It's House Bill 913. And we're going to talk a little bit about the different points and then versus the points in the Senate bill as we move forward.
Well, citizens nowadays, with the market beginning to stabilize, is what we've been seeing more frequently is doing citizens takeouts where they're depopulating. I think they've taken more than they could probably handle over the last few years, and with the intent of obviously stabilizing the market as it has been in the last few trailing months. But with that said, it's not only citizens that would be looking to doing this, it's other carriers that are doing similar actions or similar underwriting requirements whereby Milestone and SERS are an absolute requirement upon underwriting. And again, it goes back to the previous point about that barrier to entry. This is a critical part, and alongside with this, to kind of tag this along from an insurance standpoint, a lot of what has happened or transpired because of the scrutinization and everything else, due to the litigation and everything in the past few years, the changes in the legislation, what have you, underwriters are also asking for 12-month board minute meetings. Are they doing what it takes to be accountable and keeping up with what needs to be done structurally to maintain their properties and harden their buildings accordingly? And so on that note, all those things are being considered, not just with citizens, but across the marketplace overall.
So what I'm hearing you say is whether it becomes part of the law and statute or not, it's something that every association should prepare to face, regardless if it's in the law, that insurance companies are demanding that these things be done and they want to see copies of them.
That's right, Tara. In other words, this is becoming an industry standard, whether that passes for citizens or not. This is becoming the new norm in the insurance industry.
The next one is probably the biggest point of difference between the House bill and the Senate bill. Like, what happens right now if the association, they have a milestone, it says you failed, you have to do $2 million worth of work, but the association can't get the vote to pass this special assessment?
It's certainly very difficult because right now, if you have a documentary requirement that the membership approve, certainly that's the way that the board is going to go with the advice of counsel and certainly attempt to get that vote. The danger lies if you can't get that vote. And sometimes what we'll do is we'll go to lenders and say that we've attempted, we were close, and work something out with the lender in order to have them go ahead and proceed forward. But it's a very dicey situation. And hearkening back to the issue with citizens and the fact that if other insurance carriers are doing the same thing, if you don't have insurance and you can't get the money to make the repairs in order to obtain the insurance, you can't get the loans. So it's all very interrelated and certainly well-intended, but definitely problematic for some of these associations that are already struggling.
Some of the situations we're experiencing now is when we have large projects on the table, we have to get a bank loan from like a popular bank. And then unit owners hear what those assessments are. They either don't show up to vote or they vote no, because again, it goes back to the whole thing of dollars and cents. What can I afford? So to allow this and have boards under strict circumstances, especially they have to act accordingly if it endangers the health and safety of the residents, and it's only for Milestone and SEER studies, so it's kind of a controlled circumstance. In the property management world, this is a big piece of legislation to allow boards that want to do the right thing, want to protect the residents, want to move forward, and not have to always worry about getting, petitioning and getting the unit owners out.
The Senate is on the completely other side of it. I saw Lawrence Michelson commented, "This is where I worry. So many boards are rigged, for lack of a better word. But the function freeze we're all experiencing in a nightmare." The bottom line here is that's what the Senate is afraid of. They're afraid of a board having too much power, being able to levy assessments and maybe force people out. They want to have the membership to have part of the vote. I don't know if either of them, the way they read, would work, and maybe there's some alternative. Marnie, we had talked a little bit with Haber Law about maybe some attorney review. Did you have some thoughts on that?
Absolutely. I mean, associations should have counsel, especially in light of all the new legislation that we have. But working together with the banks, if you're looking at lenders right now, they're far more engaged with association loans than they have ever been before. And I certainly can defer to Rebecca as to that one. But between counsel and the lenders, they're going to be looking to make sure that what is being spent is absolutely appropriate, because the lender's not going to have that money out there without due diligence.
The other thing is when a bank gives a loan to an association, they don't drop all of the money into a fund and let the association spend it as they want. You have to go through that technical process, right? Engineer review, qualifications, pay applications, submittal to the bank, and they only pay on certain items that they have been approved. So I know the perception is, oh my God, if we give the boards this ability, they're going to get a loan and spend it on anything they want to. That's not necessarily correct.
Lopez is suggesting that they allow loans to cover 35% of the reserves, meaning the SERS, for items with a lifespan under 10 years. So what that is all of a sudden you do your SERS, and now you have these things that you're going to have to do in the next 3 to 5 years. Do you have to do immediate special assessment, or are you able to have a loan to maybe front some of those things in 6 years from now and have that line of credit set up? And will that satisfy the quote unquote fully funded verbiage that's in the law now? This is something that's also a little bit different in the House and the Senate, and Gary just alluded to it. This says you cannot provide a Milestone or a SERS and be the contractor doing the work or have a financial interest in the contracting company. We're also a public adjusting firm, so there's a public adjusting law that says if you are the public adjuster, you're not allowed to be the contractor doing the repairs. Guidelines for useful life of items on SERS. This is one that, as an engineering company, and I think as Gary will probably have a little bit of problems with, the whole idea of a reserve study is that every association is different. Something at one association that's well maintained might have a much longer useful life. And at Stone Building Solutions, we're always trying to get our associations to do items to extend the useful life so you don't have to replace them all. If you maintain your stairs, they should last for 60 years, where if you just let them sit there, you might have to replace them in 20. So I hope this section doesn't pass, because I don't think this is something that should be standardized. And then the big one is making it easier for members to force electronic voting. That goes to transparency. Gary, why would, or what is the fear of a board not allowing electronic voting? Can you explain what the big hoopla is about this?
Oh, well, if we go to electronic voting, someone will find a way to manipulate the system. Someone will find a way to see who's voting and who they're voting for. And then candidates or other unit owners can use that information to get people to vote for a certain way. I personally, in all of the last 3, 4, 5 years, I personally have never experienced an electronic voting portal being manipulated or anybody breaking security breaches and manipulating electronic voting.
When this first became law, I was fairly skeptical of it, but over time we've seen the development of these different programs to provide the safeguards that are necessary. So once the owners are locked in and they've completed all the documentation that they have, it's not foolproof, but it is fairly foolproof, and it does provide for a more streamlined process. And there seems to be a bit of deference to the process once it's undertaken, where the owners do feel good about it. And I'm having election problems all the time with mail issues and owners that are out of state, vacation or live out of state, or out of the country.
Or out of country, yeah.
And it's creating a lot of mail issues, and bless the Postal Service, it's not as reliable as it once was. So there's nothing worse than getting to the election and 3 days before everyone's complaining about the fact that they can't get something back without paying $100 to FedEx it. So it's certainly it's coming along. There's some caveats in some of the bills about just straight electronic ballots and email addresses. I'm not particularly personally a fan of that, but I don't have any issue with electronic voting. It is making it easier, and we're in the 21st century. The only other caveat I would say is, know your audience. There are some properties that to this day, this is still an event. The annual meeting is what they enjoy, and electronic voting is not for them, but they're typically not as conspiracy theory driven as some of the younger populations that we're seeing holding elections.
And everything transparent, being able to put it out there and being able to vote electronically seems like a normal thing in 2025, to me at least. Now we're going to go to the Senate and see what they have to say. This has been running rampant. Every association our reserves team have been talking to are saying, are we even going to have to do this? Is the 6 stories? I can tell you, in speaking with our CAI lobbyists and the LAC committee for CAI, that the Senate itself, the House, nor the governor has an appetite to change this from a 3-story to a 6-story option. I believe the likelihood of this passing is probably less than 1%. I can tell you the senators, Pizzo and Bradley, brought a team of about 50 professionals that specialize in this industry on a pre-session where they put it on Zoom for everyone to see, where they ask questions. And the stage was full of engineering and reserve companies, and they went one by one and said, how many stories do you think SIRS should be? Did we get it right? Should it be 3? Should it be 4? Should it be 5? And 100% of the engineers said it should be 2, because we're seeing just as much damage on 2-story and deterioration from lack of maintenance as we see of 3 or more. Okay, so what does Bradley have in her bill? This actually, if you have read it, just yesterday, there was revisions, and what you're seeing here is the most current version.
What we do is we look at any reserve component that needs to be addressed within the next 3 years. And if so, we provide a line of credit for 3 years to draw upon, and then it converts to a term loan once. If it converts to a term loan if they don't pay the line in full at maturity. It could be paid off at maturity, or it can convert to a term loan. But yes, those lines of credit are available for the reserve requirements.
So remember, the House says 35% for under 10 years. Bradley is saying 100% through 2028, meaning your immediate critical items that you need to do. Get a loan, let's get it done, let's move along. So we're seeing at least a parallel that loans at some way, shape, or form, and allowing them to satisfy some or all of the requirements in the next few years is something that both houses have an appetite for, that we'll probably see pass.
What's kind of interesting to me about this one is certainly there's a financial relief that owners will feel. What I don't know what will happen is what those loans are going to look like, what type of carrying costs are going to be there, because at the end of the day, the lender's going to have all that money available to these condominiums. and they're reserving it. So it'll be interesting to see how that plays out over time, the financial ramifications. Certainly 35% or the full 100 would have a huge financial impact on the association's assessments.
Comes to the question of what's fair, right? So a loan, if you spread that out over 10 or 15 years, now all of a sudden future residents are paying for past use. The whole idea is we want to get to a spot where everyone's paying for what they use as they use it. That's the point of reserving. So now we're in this catch-up period, and we have to catch up, and it's not actually caught up, and it's just deferred on a loan for 10 to 15 years. That might be the most palatable option for everyone. Now someone even buying the condo in 5 years, 7 years, 8 years, they're still paying for work that was done in 2025 or 2026 for work that probably should have been done, years before that. Baseline funding must be presented as an option. All right, guys, as the reserve person here, I want to talk a little bit about this. Baseline funding just means that right now it says you must be fully funded. There was not really a reserve definition that went to fully funded. People are saying 100%. They're saying, no, it's just that you have enough money. Now it's kind of the opposite. Baseline funding is that you will not go below zero, that you can stagger really, really, really close to it, but you just don't go where you have enough money. It's very dangerous because your risk of assessment goes up super, super high over time. At Stone Building Solutions, since this has been presented, we've already started revising our reserve studies to include both a baseline and a threshold. Threshold is what we recommend, where there's a little bit of padding there. Options, so the boards, as they come into the 2026 session, have a little bit more option, because we believe that there is an appetite for this, for the governor, for the House and the Senate, as kind of some kind of relief for associations. And I want to mention, if you already did your STIR study, does not mean you cannot have it done. Please contact Stone Building Solutions. We do STIRS audits for free, where we'll look at your prior STIRS and see if there's a way that there's changes and other options that can be made, and we're happy to do that at no cost. And then we can give you a new STIRS study if you like. Only STIRS items should be on the STIRS. At Stone Building Solutions, we present 2 studies. We give you one STIRS study, and then we give you a separate study, a totally separate report that has all of your traditional items, like the pool, the gym equipment, remodeling the clubhouse, whatever it may be. Pool that's in the middle of the ground, that's a traditional item. A pool that is on the roof, that becomes a STIRS item because it comes part of the structural. It's an item over $10,000 or $25,000, whatever the number ends up to, that affects the structural integrity of the building. So traditional items, yes, they're items over a certain dollar threshold, but they're also items, more importantly, in this language, that are not part of the STIRS. The whole idea is to split it up. Marty, can you kind of give us a little lesson on what they have to fund legally for STIRS and traditional?
STIRS it's a delineated list that relates to the structure of the property. It's been included in the statute since 2022. It's a list of, I believe, 8 items. It's very clear. The non-structural, there's been the wiggle room of waiving reserves, and you can no longer waive the STIRS, but the non-STIRS reserves, everyone says, let's go ahead and waive those things. Well, that's still your elevator. That's still your HVAC and your mechanical equipment. It's very expensive things. And so a matter of not including them and not fully funding them is a dangerous path to take. Not only that, but you do have what Gary was mentioning earlier, and what you've said, and what now may be increased to the 25,000. Anything on the property right now that's over $10,000 to replace is deemed a reserve. That can be your lobby furniture, that can be your pool furniture. And so if you add all those items there, it gets to be a very expensive list when you're talking about your non-structural reserves. So when you have all these items, boards used to be able to kind of pick and choose what they truly wanted to collect the reserves for, talk about it at a budget meeting, and proceed forward. Now you don't really have that wiggle room. So between the structural reserves that are statutorily controlled on what has to be there, as well as the non-structural, these items get to be very high numbers, which brings us back into the loop of whether you could actually get a line of credit for it to fund, or at least 35% of it, depending on which bill you're looking at. It's really a financial burden on these associations and these owners in order to try to meet these obligations.
The laws last year, Senate Bill 154 and House Bill 1021, clarified that you must present a fully funded study. Traditional reserve studies with boards, they'll turn around and say, well, I don't want to put that on there. Well, you're really not supposed to decide as the board that you don't want to put it on there, but you can certainly decide that you don't want to fund it. It goes back to transparency. You should be telling someone coming into the community, this is the full cost, including the clubhouse renovation that we're not going to do. Fine, but at some point, someone might want to do it and it needs to be reserved for. So the association must present a fully funded study. Then they can choose to fund some or all or none, right?
Correct. And what's very difficult is so much of the property is intertwined. It's not so easy to parse them out as we would like to think.
So this one here, if they do pause reserve funding for 2 years while doing the milestone repairs, this is going to be a huge one to give people some relief over the next 2 years in the budget process, because they're already spending a tremendous amount of money in a lot of circumstances for the projects, the structural work that's going on.
There's a caveat that if you do take that pause, you have to get an updated structural integrity reserve study before you start funding again. So what it does is it resets the snapshot of the property before you go forward. So you may have, I don't want to say relief, but you may have a difference in your structural integrity reserve study because of the repairs that you've made pursuant to the milestone inspection.
When we do the construction monitoring for a project, that's one of the things we always offer our clients at the end, is to update their SURF study because it's so dramatically different. And guys, this is the budget. The more you deal with your SURS, we say update it every single year because you can keep driving it down. And the more you look at something, the more people are aware, and you can come up with preventative maintenance and there's changes as we're having this webinar every single year in the laws. So don't just think, oh, we're going to save money because we're only going to do our SURS every 10 years. What you're going to find is that's going to cost you money. It's like anything else in finance, you have to pay attention to it.
I've always practiced from the perspective of if you have good management, you have good legal counsel. A lot of these issues, while they can be taxing to you, they're manageable. But there are bad actors. So in this situation, if you have a CAM who's had their license revoked, they can't then turn around under a new name, a new brand, start all over again. So there's truly repercussions for bad actors. I don't want to say that the issues with board members and managers losing licenses or board members being removed. This is new law, and so to see it actually play out and see board members removed, it's still up in the air how that's going to be done. But this is clear cut that if that CAM gets their license revoked, they're done.
Can you be a 150 unit condo and just be managed by the board legally?
Yes, I'm happy to be corrected, but that is my understanding, is that you can still self-manage.
I've heard Senator Pizzo speak on this on several events, saying that when condos get to a certain size, they should have management. And you as the CAM must, not may, it's must comply with the milestone and SURS requirements.
Yes, for us, we have become like the policeman for associations with those that we manage. For example, at the end of last year, we literally went through a verbal audit. Did you like a checklist for every manager in our associations? Is your association did this? Did they approve this? Is this where they are? It was literally had to be like a checklist for us as a management company to protect us as a company, but also to protect the hundreds of managers that we have out there in the field, because everybody is, contemplating, oh, I'll just send a complaint to the DPPR. I'll complain that my manager is doing X, Y, and Z, or they are forcing us to do X, Y, and Z. But yet we are complying and pushing boards and associations to do what they are legally responsible to do.
If it is a self-managed, or even if it's a managed property, say, listen, we'll come be the bad guy. The law is the law, and there's really not an option to try to avoid it. I think what we're starting to see is a lot of the problems, a lot of the lack of compliance is in smaller associations, self-managed associations. Now, I will say, unfortunately, all of these things cost money. Good management and good legal advice, it costs money. And so it is another financial burden, but if I'm a board member, it's well worth it.
A lot of people think, oh, well, I'm covered under my directors and officers policy.
Yes, Tara, D&O coverage is coverage for board members for personally and as well as their associations for liability, breach of contract. Failure to procure insurance is one thing that we always discuss because people have been looking to lower their limits or have a higher risk tolerance for affordability purposes on their insurance, at which point they're willing to risk or remove certain coverages from their policies, particularly the property, to help offset that, when little do they know that the D&O policy would not cover them for failure to include the adequate insurance.
You have to put yourself in the position of the insurance company.
Yes.
The premiums for the director and officers policy is not that much. So now these liability carriers, they're looking at Florida saying, oh my gosh, there's all this risk if these people don't do it. We don't want to cover you if you haven't done these, number one. And number two, policy premiums are rising because there's more exposure. So it will be regulated by the insurance industry because they will not give you coverage if you don't do these things and if you're not compliant, because they're not going to end up paying because you guys, or not you guys, but people do not follow the law.
Correct.
I know everybody here follows the law because they love the webinar.
No, Tara, I mean, you hit it right on the head. The fact of the matter is you got your D&O and then you have your general liability. And I said this a little bit in the pre-session when we were live, but a lot of people have put those policies to the wayside just for the simple fact that they've been seeing the property insurance premiums on such a rise and they've been so worried about the cost of insurance. But the fact of the matter is it's now the opposite. The liability insurance has really been taking it on the chin for the past few years because they've been paying out on claims of which these policies are not even intended for. They're initially intended for third-party claims, and in reality, what's happening is unit owners are seeing more and more frequently unit owners kind of suing back on the associations, whether that's board members or whether that's the association and themselves. We're starting to see a much higher frequency of those types of things. And so what we'll see more and more of is a lot more exclusions, not only being added to the D&O, which is to your point, which is failure to preclude insurance, and as well as being in compliance with the milestones. Hence why earlier I mentioned about the 12-month board minute meetings. They're wanting to see what's being discussed in these meetings, but also on the general liability side for negligence against bodily injury and property damage, as we're starting to see everyone, and this is a big highlight, construction activities exclusions under the general liability for bodily injury and property damage. It's not just the D&O to worry about, but also the general liability, where we're starting to see more and more exclusions, whether that's assault and battery, whether that's firearms, whether that's construction activities, whether that's animal liability. People are not looking into this. They're just only so worried about price. But when you don't have the proper consultation, you're missing the much bigger picture, and as well as the liability or risk that pertains to your association. Such a big discussion on that topic.
One of the other things in Bradley's bill that I really, really like is that a vote of the membership is not required to change from pooled to straight line. You don't need a membership vote to change from straight line to pooled, or vice versa. You can go with whatever makes sense for the association with the vote at the people at the meeting. A lot of the challenges, it goes back to, and this is kind of funny because the Senate is against the board having the power, but they're actually giving them the power for this. They're saying it doesn't make sense to use the straight line component in a SERS. It basically says that you can do SERS in pooled. It's just the way they've all verbally been saying it. The DBBR is saying it. Most of the legal professionals are saying it. Yes, you can pool SERS. You should pool SERS because it comes so expensive if you don't. And it's protected because it's in that account with only those structural items.
Historically speaking, over the past 3 years, we've seen the rise of cost of insurance going up. And one way associations have been looking towards mitigating or reducing their overall costs, being that property insurance accounts for as much as 80% of the costs for all of associations, particularly windstorms, since we live in the lovely sunshine state of Florida, versus we're most susceptible to hurricanes. What a lot of people have been doing as a form of strategy, if you will, have been reducing their windstorm coverage. So fundamentally, if you had a $100 million building, in lieu of insuring it to value of $100 million for windstorm, they have opted to reduce it down to either 50 million or 20 million or beyond for the purposes of reducing costs. And that's simply a decision entirely discretionary and based on affordability or available capacity. Because another issue we had was for a lot of buildings, usually in excess of $200 million, they couldn't even obtain that amount of capacity or number of insurance, which led to lending issues and all the rest. The 250-year storm was a tool that was used for many associations, also better known as a PML, or a probable maximum loss, which was an analysis that determined what the likeliness was, or the probability that an association would sustain such a loss that would meet their minimum threshold of a deductible. Most commonly in our industry, most associations have a 5% deductible. That would be 5% of 100 million, 5% of 50 million, whatever your value, true to value is. And this report simply gave the statistic based on historical storms of the past and as well as future simulated one. This is an actuarial tool report that allowed board members to make the most informed decision. The problem that was proposed with all this, and in trying to save money and thinking that they were doing the right thing, was one, the D&O issue, right? Failure to procure adequate insurance for the association left board members potentially liable. Second was lenders. Lenders were unable to fulfill their loan requirements, or they weren't able to fulfill their loan requirements because they weren't adequately insured. And thirdly, the statute 718, arguably or debatably, you weren't in compliance. And those were three things that were a little bit eye-opening to, while board members thought that they were making the best informed decision based on all those things, that were things that we needed to put into perspective and let them know that the risks that were involved with that. And so I say that all to say that it is absolutely, unequivocally, and now more than ever, with the market starting to stabilize and prices going down the way that they are, we are starting to see far more people now who have opted in this in the past years now go back to fully insured value for same like quality coverage and or price, and while reducing their costs in the insurance. So going forward, I think everyone should be looking to fully insure, and as that should be also a benefit for lending purposes and all. And I'll leave it to Rebecca to speak to the rest.
Whenever you apply for a loan, we would ask to make sure that you are 100% fully insured. If not, do you have a PML? And it has to, as a minimum, we have to send it over to our insurance department to get approved as an exception, but as a minimum that it does cover the PML amount and the loan, the total loan amount. I want to go ahead and test your bank approval for loans for repairs. We have been for 30 years and we are very busy and looking forward to assisting all communities. We do structure lines of credit for the construction periods to convert to a term loan. For long term, as I said earlier, typically our program could be 5, 7, 10, 15 years, but we do have financing available for 2025 and as exception 30 years, depending on the useful life of your projects. We try to lock the interest rate for you up front. There's no liens placed on the individual units, no personal guarantees. We do have a department that specializes in providing these loans to the community, as well as contingencies, as well as financing the insurance, as well as for the SERS. If it's for the SERS, we would ask for you to provide us with the SERS report, and we go from there.
I keep mentioning the general liability for a number of reasons. As people, more and more associations are undergoing so much construction, if there is a construction exclusion under your general liability policy, it is so important to consider either contingent supplemental policies that would pick up in the event of some type of loss as a result of a general contractor, and or making sure that there is the proper risk transfer in place or indemnification process, in combination of Marty's assistance, probably reviewing some of those contracts, as well as ensuring that those contractors have additional insured, waiver of subrogation, or even primary non-contributory verbiage within the certificate or the policy is also important, and just another layer of protection for those associations when undergoing that work. It's tremendous.
So guys, I launched a poll. I hope you can see it. There's 4 questions. These responses will get to the senators themselves. Travis Moore from CAI has promised to get these directly to Lopez, Bradley, Pizzo, and all the committee chairs so they can get your feedback. It says, do you think the Senate, and specifically because they're the ones that are not interested, should consider attorney fees for the winner and insurance claims? Do you think the boards should have the ability to assess for mandatory repairs for the Milestone without a membership vote? How many stories do you think SIRS should be for? And what's the biggest thing you want to tell lawmakers? Let them know. So you can give a long answer here and they will specifically see your response. And what we're seeing is now we had 2022 to 2024, we had to do the reports. 25, we're supposed to be looking at the reports and voting on them. And then the SIRS implemented in 2026, and you have a year after you get your milestone study in everywhere except South Florida to go ahead and commence those repairs. Do not wait to the last minute to be able to get the loans, get the vote, negotiate your contract with the contractor, go through the process, and more importantly, get on the list for the contractor so you're not waiting forever to start and delayed by time and not have the ability to select everything. You should be getting on these projects now. The time is just flying by.
There's a famous saying that we keep at Brown & Brown and we hold tight as one of our slogans, and that's, the only constant is change in this world, and that is proven to be true with every perspective in life. And so the industry is constantly up and down. And for those of you that may know, several years ago, there was a hardening of the market then. There was a hardening of the market now. But just like everything that goes up, it must come down. And there's going to be new carriers that are entering into the marketplace. Keep informed. Speak to other people. Speak to other agents and get a second opinion, because there may be markets that you may not have heard of or something that could be beneficial to the association overall when it comes to insurance. And here's what I'll leave it at. Do your roofs, do your windows, keep in compliance with your milestone. It's only in the benefit for a number of reasons for the association in the long run. So highly recommended, and please feel free to reach out. Thank you everyone for your time this morning.
Rebecca, show me the money.
I just want to say thank you very much. We're looking forward to hearing from you. We're ready to lend the money. Just make sure you get those SIRS reports, the engineer reports, and we're here to further assist you with all your products, all your banking products and services. Thank you.
Marnie, you have been such a joy to have.
Last but not least,
Giving so much legal advice, and you should have seen her live at the session too, always jumping in there. So
I
we
was
love
trying.
legal advice.
No, certainly. Again, I'm Marnie Reagan. I'm with Haber Law. My advice to you is this is changing very, very quickly. Over 25 years, this is probably one of the craziest 2 to 3 year time periods that we've seen. I cannot stress enough how important it is to surround yourself with capable, just knowledgeable professionals, whether it be management, legal, accounting, banking, insurance, because the stakes have never been higher, whether it be the criminal or the removal or the contracts. At the end of the day, board members have the obligation to take care of these buildings. And for those owners who, condominium living may not be for them anymore, if they cannot afford it, it's the board's responsibility to keep that building in such a fashion that those owners can get out. They can get mortgages, they can get lenders to assist them, and that owners and purchasers will want to come in. So it's really extremely important to do those things and surround yourselves with those professionals. We want good board members to continue to serve, and we want to clean up some of the wrongdoing that's been going on.
And we want to give a shout out to Condo Connect. They are the one that put the pre-session webinar together and the pre-session live. Daniela Marquez puts on, I'm telling you, the best industry events I've ever seen, top notch. It's like, this is how it's done in Miami style. It's just gorgeous. She's actually taking this road show with different vendors and politicians and your industry professionals coming all across Florida. So keep an email out or keep an eye out for any emails from Condo Connect. And I highly suggest that you participate in all her events. And thank you from the bottom of our hearts at Stone Building Solutions, where don't make 5 calls, make 1, do all kinds of engineering, construction monitoring, reserves, insurance evaluation, safety inspections, damage claims. We're here to help. Stonebuilding.com, and everybody enjoy the rest of your week. And thank you for joining.